Well, hello everyone, and welcome to the Home Buyer Readiness Workshop. I am so excited to be spending this time with you, and thank you for spending this part of your day with me. If you don't know me, my name is Amber Jones. I am a certified mortgage advisor. And full disclosure, my goal is not to convince you to buy a home tomorrow, believe it or not. But rather, I'm here to help you understand where you stand today and help you identify the next steps that are going to move you closer to homeownership. So, before we get started, this is a workshop. So, there is a little bit of work. There will be some action steps along the way. So, you are going to want to grab something to take notes on. But if you would also like to download now, I have a workbook ready for you. And you can download that workbook here using this link, and you can follow along with that. But I will share it again also at the end, just in case there's any challenges with that. But then that way it'll help be a step by step guide. It's also available on my website at loansbyamberjones.com. And throughout this presentation, it will be interactive, although I am the only one on camera. You will have the opportunity to ask questions, and then I will make sure to get to those at the end. So at the bottom right hand corner of your screen, you should see a chat bubble where if you click on that, you just have to type in your name for who you are, and then you can write your questions right there. So let's get into it. All right. Before we jump into the presentation, I did think it was important to share at least a little bit about myself, my journey to homeownership, and also in the mortgage industry. It all started in 2002. My mom had opened up her mortgage brokerage company while I was still in high school. So I started out as her assistant, and I helped her build up that brokerage. And then fast forward to me graduating high school in 2005, I took the real estate exam. I passed. And then 4 years later, upon my renewal in 2009, I went for my broker's exam. So I was able to get my broker's license, which then gave me the title of mortgage broker. But more importantly than that, having my broker's license during that time, it allowed me to help homeowners with loan modifications, and then it also allowed me to help realtors with short sale negotiations during the housing crisis. So while that was a really difficult time, and there were a lot of challenges navigating that, what it taught me was that there's almost always a solution if we are willing just to take the time to look for one. So fast forward now to 2013. My husband and I were about 2 weeks away from having our third baby, and we wanted to buy a home. We were now going to be a family of five. So, of course, we wanted the house with a yard and a bunch of bedrooms for these kids. But that just wasn't in our budget. And we knew we didn't want to keep renting. So we just had to adjust our plan and our expectations. And we ended up buying a townhouse. So at the time, it wasn't our dream home. And we knew it wasn't going to be our forever home. But we knew that it was going to be the next best step for us. So we adjusted our plan. We set new expectations and we said, okay, we're going to give ourselves 5 years. And in 5 years, when this little guy is on his way to kindergarten, then we're going to get the home that we want with all the bedrooms and the yard. And 5 years came and went, and life was lifing during that time. My husband had two knee surgeries, and we even navigated him getting laid off during COVID. And so our 5 year plan ended up taking 8 years. But thankfully, in 2021, we were able to buy the home with the yard and each of the kids being able to have their own bedrooms. But even that wasn't perfect. In fact, in both 2013 and in 2021, we both got to pay slightly more than what our property appraised for at the time because we were purchasing in a really extremely competitive market. So if somebody says, "Hey, Amber, do you think that I should pay more for what's being asked for this home?" I would say, "Well, I did it twice and it worked out for me. It's just going to depend on, how long do you plan on keeping it?" So it it all worked out. And also, we were actually able to keep our townhouse as our first rental. So if that's also something that you're thinking about, that, I want to buy this one and maybe this isn't the forever home and you want it to be a rental, and buy something else in the future, well, I definitely have experience with that as well. And last but not least, if anything, this might be the most important point, that I was my own worst client twice. I am naturally detail oriented. I ask a lot of questions. I consider multiple if this, then that scenarios, and I can be pretty impatient. While these qualities make me an amazing mortgage advisor and to help make a smooth process for clients, it can create some tension and maybe a few challenges, if you will, as a life partner. But I am this way and I am a work in progress. But why do I share all this with you? I think it's important to know that, this is a big moment in your life to consider, and it is reasonable to have big feelings along with it. So if you're nervous, overwhelmed, uncertain, that's normal and it's totally okay. This is likely going to be one of the biggest financial decisions that you are going to make in your lifetime. So I expect questions. Concerns are also expected. And that's why we're here tonight. All right. So now for the good stuff. So tonight we're going to identify 4 common gaps that I've seen in my experience where people often keeps them from being able to move forward. So we're going to look first at your credit score, then we're going to take a look at the budget. Finally, third, we're going to look at funds available. And then last, we're going to look at expectations. And when we're looking at expectations, it's not just what type of property or the features that you want to have in this property, but also making sure that you identify what a win is going to look like for you for your situation. So, one of the biggest misconceptions that I see is that people think they already know their credit score, especially if they, see the credit score on their credit card apps or Credit Karma, and they assume that that's going to be the score that a mortgage lender uses. But unfortunately, it is just not the case. Mortgage scores can be slightly different or significantly different from what you see online. Sometimes they're higher, sometimes they're lower. But it is important to know where you stand for the purpose of what you're having your credit run for. So in this case, it would be for a mortgage. It's also important to remember that this score doesn't define you. It's a number, and numbers don't have feelings. It's just simply a tool that will help you determine which programs are available to you, what your interest rate is going to look like, and what your monthly payment might be. Now, can a higher credit score translate to a lower rate, which will equate to a lower payment? Sure. But sometimes the difference in going from 720 to 740 or trying to get from, 700 to 760, sometimes the difference for the impact on the rate for your situation, it might only be an eighth difference, which if that's going to equate to 30 or $50 a month, sometimes because of that small difference, it's marginal and doesn't even make sense to keep waiting. So you can't create a plan if you don't know where your starting point is, and the credit score is the first piece of that. Many buyers are also surprised to learn that homeownership may be possible with a lower score than what they had expected. So, should you try to have your score be as high as possible? Absolutely. But maybe it's going to take too long to get there. And the market that you're trying to purchase in just continues to accelerate and get more and more expensive. And you're like, you know what? I'll just take it now, continue to work on my credit, and then attempt to refinance in the future. That's also a strategy. So if your credit isn't where you want it to be today, it's totally fine. It can be improved. But the key is just to understand where you are and then what actions will create the biggest impact. So, as I mentioned in the beginning, this is a workshop and you are going to have some action items. So, our first one is going to be that you want to request and review your credit report with the mortgage scores to know where they are. There's a lot of options to request a credit report. You have a free credit report at annualcreditreport.com. You can go to the bureaus directly, but those won't give you a score and they won't give you a mortgage score. So, in order for you to actually have your true mortgage score from all three bureaus in one credit report, you're going to have a hard inquiry by a mortgage lender. So, I can help you with that request. If you want to be able to request that, you can. You just go to, and I will include a link here just for you to be able to write down. You go to loansbyamberjones.com/request credit. The cost is $135, whether you're running a joint report with a spouse or your individual report. That report will be good for 4 months. So if you run it and then you go through the rest of this presentation and you're like, you know what, I actually think I'm better off than where I thought I was, we can actually use that for your pre-approval, get you going, and then who knows, by the end of summer, you might be making offers. Or if it identifies, hey, we have maybe some work to do, you need help either building or repairing your credit, I can then take that credit report and I can refer you and connect you with a credit repair company that I recommend called My Credit Guy. And I like them because number one, they offer free consultations, and that's awesome. But more importantly, they have an extremely transparent pricing on their website, and they also have accountability built into their systems and processes because they have a portal that I log into, and they keep me updated not only in their portal, but also through emails and phone calls as well to let me know how your progress is going. All right, next, let's get into the budget, or for my spenders, your spending plan. So, a lot of people will reach out to me and say, I need to see how much I can get pre approved for. How much house can I afford? But really, the better question is, how much of a house do you want to afford? Because as lenders, we approve you using your gross income before taxes are taken out, but you pay your bills on your net income after all the taxes are taken out. So I encourage buyers to identify what is their maximum comfort payment. And that's one of the questions that I will ask during my initial consultation call. And this number will include not only the loan payment, but also the property taxes, the insurance, and any mortgage insurance. So while you're reviewing your budget or spending plan and looking at these numbers, and identifying what your max comfort payment is, you'll also want to look at what are the expenses that you can control without having to make any major adjustments. So, some of these expenses are going to be fixed and irregular, and your ability to change them are going to typically require some really thoughtful consideration and intentional effort. So, those things are your auto loan payments or your rent, or your auto insurance. You can change those, but you're either going to have to move or sell your car or refinance your car or shop and get a new insurance policy. All of those things will take a certain amount of time and research for you to do. But there's other expenses, and these are the discretionary ones. These are the ones that are in immediate control. You could probably even do something either tonight or by this weekend. But think of these things like conveniences or entertainment. So, DoorDash, Instacart, the subscriptions, or TV, entertainment platforms, things like that. And also, it's important to remember the goal isn't perfection, but it's awareness. So, on to our next action items. You're going to want to review the last few bank and credit card statements to see what you can immediately stop or cut from your budget. Then, once you've identified your max comfort payment, you want to compare it to your current rent. The difference between those two numbers is often where you have some saving opportunity. So, a lot of times when I have a consultation call, the amount that somebody is paying for rent and what they tell me is their max comfort payment are two different numbers. So, for example, if you're currently renting at $3,000 a month, but you say that your max comfort payment is $4,000, well, then there's $1,000 difference right there that immediately can start going into savings. So, the next action step is to set up that auto transfer. So that way, when you pay your rent, the very next transfer that happens is going from your checking to your savings account. So that way, you can start to test your budget and you can start to feel what the home ownership budget will feel like without having that commitment just yet. That way, if you need to make adjustments, send some money back, try to cancel some more things or just move things around in your budget, you can do that while still working towards finding your true comfort payment. And as you're reviewing those discretionary expenses, just one fun fact about how we do things in my house, because I do review this at least every 1 or 2 months. But during football season, we'll have our subscription for whatever TV service. Like this past year, it was Fubo. I'm not sure what it's going to be this upcoming season. But then the Monday after Super Bowl, I cancel it. And so it's like we have it for a season and then it's short lived. Sometimes I'll have Apple TV, but if to watch like a show for a short time and then I'll cancel it. So, you can be strategic. Yes, it takes a little bit of effort, but you can also pause them as well, because I've done that with Audible a couple times. All right. So now we want to go into the all in investment. And another thing that comes up when I'm having conversations is that buyers are really just considering and concerned about their one number being the down payment. But really, there's more costs involved. There's closing costs on top of the down payment. And sometimes, depending on the scenario, we have to have reserves. And even if you don't have to have reserves, it's sometimes smart to at least have a month or two in savings if you can, because there's always going to be something that comes up in that first year of homeownership. For some reason, for us, each time it was a water heater that went out. I don't know why, but that's what it was. And or even sometimes it'll just help with moving costs. So the good news is, though, that you don't have to have it all in one place. It can come from multiple sources, and you just want to identify what those are. So it could come from your personal savings or money market accounts. You could also potentially have access to your retirement accounts. Maybe you have access to gift funds. And then there's also down payment assistance programs. So it's not just a question of, how much do you have access to, but also where is it going to be coming from? And with the down payment assistance, I want to touch on that just for a little bit, just to give a little bit of context, because sometimes there's a lot of misconceptions there as well, where folks think that you have to either be a first time home buyer or have really, they're really strict on income limits. And that's just not the case. So there's multiple down payment assistance programs available, but they do come at a cost. And typically that cost is you get the down payment assistance in exchange for a higher interest rate. So, for example, I just recently helped first time home buyers purchase their first property using not only down payment assistance, but also closing cost assistance. And in their case, it was also on an FHA loan. And where their scenario landed with the assistance, they ended up being in like the mid 6% range. If they wouldn't have needed closing costs or down payment assistance, and they were able to bring in their own funds with just the 3.5% down and closing costs, their rate would have landed right around the mid 5% range. The difference in monthly payment for them was about $350 a month. So they happened to be able to manage it, and that was worked in their budget. But one of the things that is always a part of the down payment assistance conversation when I'm looking at that is the refi planning for the future. Because down payment assistance isn't meant to be a long term solution. And again, it's typically at the exchange of a higher interest rate. So even if interest rates stayed the same over the next year or 18 months, that particular client 9 months from now will be in a position to refinance and likely be able to have their interest rate a point lower because that's where it was when they purchased. So they'll be able to save a couple $100 in the future. They're starting their home ownership journey now, and it all worked out. And down payment assistance isn't for everybody, but also I'm not going to talk negatively about it because it can be a workable solution. All right, now for some more action steps. So, if you have cash at home, we want to make sure that you get that into the bank right away. How you get it into the bank, like as far as how often or the amount, like the increments, that's strategy. We can talk about that, but we need to get it into the bank. I can't use it if it's not in the bank. Also, if you are going to have a potential gift from a family member, if that is a possibility for you, you're just going to want to make sure you start having those conversations now to see how much you're going to be able to work with, because that may impact, the other numbers as well. So it's always nice to kind of start with that one first. Then, if you have access to a retirement plan, whether it's with your current or maybe even a prior employer, you can reach out to them and see how much do you have access to. It's important to let them know that you are using this to purchase a home. And if it is going to be your primary residence, that you let them know that as well, because sometimes they treat the purpose, if it's going to be for purchasing your primary residence, differently than if you were just pulling out the money for a hardship that may be like something medical or an unexpected emergency. And sometimes those have penalties where it's possible that maybe you won't have penalties if it's associated with a real estate purchase. So you want to, all plans are different. You want to call and find out and then see how can get the funds. Is it possible to do it as a withdrawal? And or if it's going to be through a loan. So if you take a loan out against the retirement, then you will have to, have that incorporated into your budget because they're likely going to deduct it from your paychecks. But we don't have to count that payment against you in our debt to income ratio in the way that if you were to go to the bank and get a personal loan and get money out that way and have a loan payment for that, we would have to include that into your debt to income ratios. And then also, as crypto is getting more popular, that does come up, can I use crypto? You can, but you have to look at it like any other investment account or a money market account or stocks. You have to sell it or convert it to US currency. And then it has to be in a US bank, not US Bank, the institution, but a banking institution within the United States. All right. So now that we have worked towards identifying gaps in the numbers that we're working with, now let's work on our expectations. So, first, it's important to know what you want. Take the time to dream and give yourself that, ability and space to envision the type of property that you want. What is the ideal outcome for your living space? The bed bath count, the square footage or layout or flow of it, your must-haves. For me, it was central air and being able to do laundry on my property. It's okay if it's in the garage or if right now it's in my kitchen. But I didn't care. I wanted it on my property. So you want to find those what's going to be those must-haves for you. But then you also want to compare that to the current space that you're living in now and how much of a gap is that? Are you currently in a two-bedroom apartment and you're like, okay, yes, we're growing or we're expanding or we want to or we're working from home or whatever the situation might be where you're like, I want a four-bedroom house and that's really what you want. But could a three-bedroom work? Like, could we look at that as a stepping stone? So that's something that's important to consider. You want to have the dream of everything, but then we also want to test it and go, okay, but what can we make work right now? Another thing to look at is, the expectations that may have been put on you by somebody that cares about you. So maybe you had an important family member tell you that you need to wait until you have 20% down. So that way you don't have to pay mortgage insurance because when they bought their house, they put 20% down and didn't have mortgage insurance. Okay. Well, if they bought their home 20 or 40 years ago, the number was less. It was maybe a little easier back then to come up with the 20% down on, that income. Where now, if you only have, 3 to 5% down, or you're just getting started and the current, market that you're trying to get qualified for is little expensive, it might be extremely challenging as far as like the time frame trajectory that you'd be on for that. So you may want to consider those options as well. But in addition to that, you also want to look at, what is a win going to look like for you? And what is winning going to look and feel like in this process? So is that going to be you being able to buy a home for less than what it's currently listed on online? Is that going to be like, yes, I got a good deal because it's less than what I got? Or I got the seller to pay all my closing costs. Or is it that, you see the average rate posted on freddiemac.com or some other bank's website or something, and you're like, yes, I got a lower rate than what the average is in the marketplace. Like, that's the win. Or is it not even financial at all? And the win is rather in timing. And you're like, yes, I got into this house and we were able to move before the school year started or before this particular important holiday where you want to be able to be all moved in and settled and host family for that important holiday. All right. So now it's time to recap our action steps. So, first, you want to request that credit report and identify any opportunities for improvement. Next, review those expenses over the last 3 months. I know it's not fun. I know it's not fun. I promise I do it and I still don't like it. But you want to try to cut one or two things immediately. I want to challenge you with that. Set up that auto transfer for the difference between your rent and what you think is your max comfort payment, and get that going. Start next month, right before July 4th. Maybe you got to cut back a little bit on your fireworks, but that's okay. We're working towards a home here, and start getting that going. And then you also want to list out all of the available, savings or just different accounts, and then what you have available to you from those. And important, any cash you have, get that sucker in the bank. And if you have any access to retirement plans, make sure to call them and find out how much you actually have access to, and then the methods that you have and what that's going to look like. And then finally, it's time to dream, but also challenge your expectations. So focus on what you need today, not necessarily your final destination. I remember when we were first looking at, first getting into the townhouse and then also coming to this property, it was, thinking about, oh, the family of five, the family of five. And I realized, oh my gosh, like I have a kid in college now and he's gone most of the time. And I'm like, wait, I need to not look at this like everything is just so permanent. Like this life is happening in seasons. So I encourage you to do that too. And also comparing the must haves to what's nice to have and helping to identify the property that is going to help fit this current season of life. And then once you have all of those pieces of information, the next thing is to book a call with me. You can go to my website, loansbyamberjones.com/book-a-call. Or if you just go to loansbyamberjones.com, it'll say, like, I think I'm getting ready or something like that. One of the top left buttons. That's how you can also schedule a call with me there. Or if you go to my website, just scroll all the way down, you'll see my other contact information and email, and we can get something scheduled. But it's important that we then have that conversation because I'm going to ask you on that call, what is your max comfort payment? How much do we have to work with? What does your credit score look like? Why are we talking today? What's the motivation? What's the time frame? What does a win look like for you? Anything else I need to know? And once I have that information, I'm then start the framework. We need a foundation. We need something to build from. And I'm able to then run some numbers and send those to you and say, hey, based on what you told me, this is what the numbers look like. Do we want to keep moving forward? Does this make sense? And now it's like, hey, we're getting fully pre-approved and now we're writing offers. Or is it, hey, we're getting ready to now plan the next steps. And then now I'm your accountability partner along that journey of getting you closer to being able to be in a position to get pre-approved. All right. Congratulations. You are one step closer towards homeownership. It is important to tell yourself, like, I know the daily decisions sometimes can seem so insignificant and mundane, but this will not happen by accident. It is going to take intentional effort. And if you do have intention with your next steps and you have a plan, it is only a matter of time before the stars align for your situation. I promise you that. If you haven't already, you can visit my website to request a copy of your Home Buyer Readiness Workbook. That workbook will take you step by step through all of the action steps that we went through tonight, and it will get you that much closer. So that is it. I thank you so much for your time with me, and I am going to go ahead and check the chat to see if we have any questions. Let's see. Okay, when do you think I should pull my credit if I'm going to start looking for a house over the next month or so? Can you help me find a realtor in my area? I'm so glad you asked. Okay, yes. So because the credit reports are good for 4 months at a time, technically 120 days, but it's 4 months. I would say if you like the numbers with, because how my cadence of how I like to do things first is look and ask those important questions and then say, okay, based on that, what you're telling me your max comfort payment is and how much money we have to work with, those two numbers are going to tell us our max purchase price. If these numbers work, then we're ready to move forward and get you pre-approved, because now it's like, hey, we're ready to make offers, unless there's something holding you back that might be, you're in a lease and you need to wait for that. That would kind of be the only thing I would say is going to be more of the timing thing to consider. But otherwise, if everything else is working and it's just looking to be in the next month or so, I would say yes, do the full, credit check now, get the numbers going now, and that way you can have everything in line. And absolutely, I actually have access to a database of realtors nationwide, people that I know, like, and trust, who do business the way that I do. I don't buy leads. I don't advertise. Uh, I build my business by relationship and by referral. So in order for me to do that, I have to, invest in my relationships and handhold, and that's one of my favorite things. But that's one of the things that keeps me going. So I am able to build relationships with realtors over time as I go to different conferences and, different networking events. So yes, absolutely, I can find you someone in your area. And any other questions? Oh, thank you. Thank you. Thank you. This was recorded, so hopefully I will also be able to share it after. So we will see. But any other questions before we wrap up? All right. Hearing none and seeing none. Oh, okay, wait. I see another one. Just kidding. Husband has W-2 income and self-employed. Can I be on the loan too? Yes. So with self-employed income, or with any income in general, how we look at that is, what are you paying taxes on? So in the case of somebody who is self-employed, naturally, first step will be looking at taxes. And what are those taxes looking like? And I'm not the underwriter. I'm not the decision maker. So it's a nice little buffer, because once an underwriter sees something, they can't unsee it. So I like to look at the taxes first and go, okay, how's this looking? Or are these taxes going to open up a can of worms that maybe we don't want to see? And then maybe there's going to be some alternative options like bank statement loans or other types of, like, uh, you know, P&L loans, or just other creative outside the box options that we have access to. But yes, you can have a W-2 income borrower and a self-employed income borrower on the same loan using both of their incomes. Or if the W-2 borrower qualifies by themselves, like you qualify, but with just their income, you don't even need to say that you're self-employed or show the tax returns, unless you, like, own property and we need to use rental income for that. But otherwise, if we're just using a W-2 employed person, then we have pay stubs and W-2s typically. And then the other borrower could just be listed as a borrower with no employment or income information. So remember, there's no discrimination allowed. So if you're choosing to either not work or be a homemaker, you can't, we can't say, oh, no, you can't be on the loan. So yeah, that's not going to be counted against you. And we can be strategic. So let's see. Okay. Do I think interest rates will increase over the next 3 months? Okay. So keeping me on my toes here. So while I'm a mortgage advisor, I am not a fortune teller. But what I can tell you is that I listen to some really important people, and you can too. No, but so the major economists that are looking at our market and the economic activity, and they're being paid to analyze, what's going to happen through this administration and then kind of the next one. Fannie Mae, Freddie Mac, National Association of Realtors, the big Redfin, Zillow, the big dogs, they are all thinking that, rates are going to land somewhere between high fives and low 6% range by the end of this year. That was the prediction in January. The conflict in Iran made that a little spicy, but It's not throwing us off too much. If anything, maybe we're just going to stay in that like low 6% range. And now these are just averages. So could you buy points or pay points to get a lower interest rate? Yes. That's just means that it's going to be more closing costs, and maybe your budget can afford that. But as far as the rates increasing, if they have been in a really tight range for, I would say, the last year to 18 months. So if they increase, it's likely going to be, my guesstimate is like within an eighth or a quarter of where they would have been. But because we have a new Fed chair, and we now have a peace deal, and there's other improvements that the economists and that the market and the investors are thinking is going to be good news. The market expectations and market sentiment is really driving investor behavior, and what they think is going to happen is kind of what's impacting interest rates. So if they think that inflation is eventually going to come down, then we're likely to see mortgage rates improve. But if they think inflation is going to increase, like what we had seen, kind of in the last 3 months with gas prices and groceries and different costs just kind of going up with the conflict, then it's like, okay, well, if inflation's going up, then, rates aren't going to be coming down. So then, it can have them stay elevated a little bit longer. So, but as far as them increasing over the next 3 months, no, I don't foresee that. I think that they'll be steady, maybe slow to decrease if we saw improvements. But again, we're still in a pretty tight range. So, all right. Well, thank you so much for spending some time with me. I'm so excited that you were able to join today, and I hope if I'm seeing no other questions, nope, no other questions. I hope you have a great rest of your day.